I want you to look very closely at this image. This photo is from one of the 2025 LA County fires. Wait, hold on. What's up with this house? And this house? Wait, and this house? What if I told you there is a company that predicted which houses would be the most likely to survive a disaster like this and agreed to insure just those houses? More than $22 billion in insurance claims have been paid after the LA fires as of March 2026. For that one company, they had 0 losses. How did they do it? Now, more and more houses, entire zip codes are becoming uninsurable, aka too costly to insure. Companies like State Farm, Allstate, Farmers, they've all pulled back disaster coverage from states across the country because of this. So what is the secret to insuring only the right houses? There is very much a deep, decades-long flaw in how traditional homeowners insurance companies work, but 3 starters have come up with 3 radical new approaches to revolutionizing this industry.
You look at the companies in the space, their average age is 100 years old. Isn't that crazy? That's not our oldest competitor, that's our average competitor.
I've been obsessed with understanding how they did it and why they're betting on this one thing that every other insurance company is running away from. But first, we need to understand the flaw that made the old guard abandon 6 million homeowners. Now, here's what homeowners insurance companies are supposed to do. Let's imagine that this is my house, and there is a non-zero chance that a giant male model is gonna destroy it. Or, well, that it just burns in a fire. And we actually know what the odds are of that happening. In the US, there's about a 1 in 413 chance of a house experiencing a fire each year, according to the California real estate company Ruby Home. That's a fire, by the way, any fire, not specifically wildfires. Now, if I am the unlucky 1 in 413, then I probably have to cover all those costs myself. But what if I could convince 413 of my neighbors to join me and put 1/413th of the price of each of our houses in a pool of money? Now, if we play by the odds and one of our houses burns down, then the pool of money will cover it. Great. Now, that is, in theory, what an insurance company should do. But things get complicated really quickly. Now, what if a fire is due to some irresponsible owner or like some intentional, purposeful arson? Or what if more than 1 in the 413 houses burn down in a year and the pooled money just can't cover both? Or how do you calculate the extra risk of a possibility of a flood, for example, or a hurricane? Or how do you work out how much a wooden shack pays against the state-of-the-art house with a fire suppression system? In a capitalist world, nobody wants to do all this without some sort of profit. And you still have to account for other stuff, like the standard corporate structure, like these homeowner insurance companies. They have their marketing costs and their C-suite and their well-paid CEO and the marketing mascot, right? Somebody has to pay for that too. And just to make things a bit more complicated, these companies have started to separate homeowners insurance from disaster insurance, which kind of defeats the purpose, if you ask me. And at one more layer, there are also insurance companies that pool the risk of other insurance companies. This thing is called reinsurance. So this utter mess of underwriting, risk, premiums, corporate overhead, that's America's insurance market. Now, according to this study by Vanderbilt University, 38 cents out of every dollar that you pay in property insurance premiums, they're gonna go to that corporate overhead. And I could complain all day about this, but at the bottom of this spiral, there is a bigger problem. There's a fatal flaw in how premiums get estimated. Now imagine my 413 home neighborhood sits close to a canyon. Homes that are close to the edge of that canyon have an extra risk because, well, they could fall off. No, seriously, like shifting soil under a house's foundations can cause whole houses to go down canyons, just like happened a few years ago in Utah. So maybe those houses on the very edge should pay a higher premium for that. But that doesn't usually matter to your insurance company because the main factor assessing the risk of this home is not specific direct risks like this. It's the entire zip code. Zip codes were established to help the Postal Service sort mail faster. They were never intended to map out the chance of environmental hazards. And yet, because of that, all the houses in that zip code, they share the same risk, they share the same high premiums, and in some cases, they are all flagged as uninsurable. Take, for example, Glades County in Florida. Now, out of every insured home in 2017, 99% of people renewed their policy for another year. Pretty standard non-renewal rates. However, in 2023, only about 84% of people renewed their policy. That is a spike of over 3,000% in non-renewals. That's people who had insurance and didn't renew it, either because coverage was denied or because it was unaffordable. Glades County is a perfect storm of insurance. It's one of the state's poorest counties, and more than half of the properties in Glades County are manufactured or mobile homes, which are riskier for insurers. And there's also, of course, Florida weather.
Milton slammed into Florida with winds of more than 100 miles per hour, all right on the heels of Helene.
All of Florida, not just Glades County, is at risk as hurricanes get stronger and more frequent. Private insurance companies, they simply don't want to bear the risk, and they've started to refuse coverage or made the premiums so unaffordable that nobody can pay them anyway. Those non-renewal rates have spiked all over the state. The fallback, last resort for those homeowners, is the government. Now, Florida is one of 34 states across the US that have this state insurance company that only insures homes that were rejected by private insurers. But these state insurers, they're really a temporary patch to a much bigger problem. Now, one of the biggest criticisms is that if their pool of premiums depletes when covering damages, the remaining capital to cover them has to come from a fee that gets charged to the other private insurers in the state, which, of course, they will pass on to their customers. So all of this, the types of home, soaring litigation costs, worsening weather, and extra government fees means that since 2020, more than a dozen insurance companies have either gone insolvent or stopped offering disaster insurance in the state. And the same is happening in Louisiana with the weather and California because of the risk of wildfires. Now, you would think the problem with a home not getting insurance stops at the homeowner, but it's really like a death spiral that affects the entire community. If a zip code's premiums become unaffordable, new buyers won't be able to get loans to buy those homes. Then the entire zip code can lose millions of dollars in property value almost overnight. And when property values tank, that directly impacts local property taxes, which in turn affects public services like schools and police and fire departments, the infrastructure that could reduce risks to homes in the first place. Now, that's exactly why you would assume that no insurance company in their right mind would want to touch any of these abandoned zip codes. But this new wave of tech startups is doing exactly that. They realize that the problem isn't the houses, the problem is the map. Well, what if instead of looking at an entire zip code, we started looking at each house? This would have been impossible a decade ago. There's this company called Kettle, for example, that created a model to do exactly that. Now, Kettle doesn't care that your home is generally located in San Bernardino. What they do instead is they pull satellite data, they pull optical imagery, they pull lidar, and they build this 3D topographic model of every single property. Now, on that extremely detailed file, there's an AI model that can, for example, look at the slope gradient around your house and determine if a fire is going to affect it because fire tends to move up slopes faster. It can also measure the exact distance between your home and the nearest highly flammable vegetation. So instead of calling all the homes in the zip code uninsurable, Kettle can find the safe house, the house that's not going to burn down, that's hiding right in the middle of that zip code, and insure those houses and offer those homeowners wildfire insurance. And their math is actually scary accurate. According to their website, when they stress test their machine learning model against California's historical data, their AI successfully predicted 97% of the properties that actually burned. Now, it is not easy for a company to break into an industry as complicated, as regulated as insurance, but if you're facing a predicament like that in your own space, you should check out our team's guide to break into these monopolies. It includes 10 complete, thorough cases on industries that are monopolized and ripe for disruption. Everything from commercial waste management to beer. You can grab it using this QR code or by clicking the link in the description. But the question about Kettle, of course, is, does it work? Do these predictions work? And the best proof of a real scenario is this company called Delos, which, just like Kettle, is analyzing all these hundreds of variables, satellite imagery, vegetation, health, topography, and there's proof. Now, despite having 25,000 policies written across California, including areas where traditional models considered to be like wildfire exposed, Delos experienced 0 fire losses during the Palisades and Eaton fires. 0 losses. They are now expanding coverage to hundreds of thousands of Californian homes that have been deemed uninsurable or that have landed in that last resort state insurance plan. It's called FAIR. And they estimate that as many as 50% of those homes could be eligible for coverage under their system. But by far, my favorite industry-breaking example is companies like Kin or companies like Pure. Now, remember that mess of overhead on top of the insurance premiums? Well, this company is a path to skipping that altogether. Now, first of all, there are no middlemen with Kin. Kin looks to sell directly to consumers, and it does that online. But the real genius is how they handle the risk. Because Kin doesn't actually insure you. You and the other homeowners, you insure each other. The way the OG insurance was supposed to work in the first place. This is a model called reciprocal exchange, and it's much closer to this pure 413 houses example.
It's a business model that's existed for 100 years, but was sort of underutilized.
Now, what happens is the policyholders will pool their money together to cover their losses, and Kin simply acts as a tech platform that manages the data and the AI. And they collect a fixed management fee for doing that. It's 32% of the premium according to Forbes, which is 8% less than the typical insurance structure. In other words, this pool of money belongs to the homeowners. Kin is just like a manager that keeps the company isolated in case of a disaster, right? They don't have direct volatility in case something happens. Now, on top of the money pool, they tap into global markets. They issue catastrophe bonds. That's kind of reinsurance in case the pool runs out during some catastrophic event. And yet, because of the advanced risk technology that these guys have, in 2025, only about 21% of the pool of premiums had to be used to pay claims. The rest just stayed in the pool.
Fundamentally, the way you win insurance is by understanding the risk better. Our challenge from the beginning, we're like, look, we don't deserve to be in this business unless we know that we can understand the physical traits of a house better than everybody else. And we had this thesis that we could use technology to do that.
As a company, though, they have the advantage of being insulated from disaster losses. It is not their money. The money actually belongs to the homeowners. Now, in traditional insurance, whichever money from the pool of premiums isn't used to pay claims, well, it becomes profit for the company. Traditionally, that's been around 30 to 40% of the pool that the company is just rewarded for not paying out to the people of their insurance. They just keep it as profits. But with companies like Kin or like Pure, because the pool of money still belongs to the customers, the underwriting surplus is placed in a savings account and can actually be used to reduce future premiums and sometimes even to be recouped as dividends. How much do your customers understand how different your model is from traditional insurance?
What we think the most important differences between Kin are is really that we're using technology to do a lot of stuff that was done by people before, right? And that's what makes their insurance cheaper. It's what enables us to insure the homes that are in harder to insure areas. It's what makes our user experience better. And that's really what resonates with customers.
Now, I wanted to complain. But I have to say that this is a pretty awesome model. Like, why doesn't all insurance work like this? What is the catch with this? Now, I did find a few complaints on Reddit around claims being denied and around slow payments, but the most controversial issue has been the handling of claims around Hurricanes Ian and Idalia. Now, regulators said that they found that the company failed to provide disclosure statements for both hurricanes and failed to pay or deny claims within 90 days for Hurricane Ian. And with the other examples, Delos and Kettle, there's of course the question of how accurate the AI is as they expand to more and more homes. We have to be sure that we can trust their AI models, of course, but also part of the reason why expansion is slow or limited is because there are so many old school regulations around insurance. For example, in California, there's this law from 1988 called Proposition 103. It forces insurance companies to justify their premiums using strictly historical loss data. Fair. That was originally meant to protect customers from rate hikes, but now it's blocking companies like Delos from using a forward-looking model to estimate the rates. The state just forces them to look backwards. But as climate change accelerates, the past no longer predicts the future. Florida, on the other hand, they don't have Prop 103, but they have this massive litigation loophole. The Florida Insurance Commissioner found that Florida, they accounted for 9% of all homeowners insurance claims in the country. And yet, they generated 79% of all homeowners insurance lawsuits. Contractors would artificially inflate repair costs and immediately sue the insurance company if they disputed it. This happened over a 10-year period. So Florida insurers paid out $51 billion in claims, but 71% of that money, it went directly to the attorneys and to the public adjusters. That money didn't go to fix houses, which is a big disincentive for companies to operate in the state.
The claims experience is so messed up. It is getting worse. The whole industry is designed not to accept change. The laws are designed that way. They want stability, protect the customer. Like, these are all good things, right? And so it's a very difficult thing to push the envelope on the technology, but still satisfy the requirements of the regulator.
And then finally, of course, there's reinsurance. That's the insurance for the insurers, which these companies, they still need to get in case they're wrong. But reinsurance companies, they still rely on the historical data, and they're raising their prices drastically or refusing to cover certain areas at all. Now, if the global reinsurers won't back your portfolio, you simply can't scale your startup at full speed, no matter how good the tech might be. Now, AI gets this bad rep, especially generative AI, and I get it, but I have a hard time thinking of a better use for machine learning technology to insure homes and to help us adapt to this reality of our weather. Now, one thing that absolutely blows my mind about all of this is that people still build mainly wooden houses in America's infamous Tornado Alley. I made a whole video about that some months ago. You should check it out. And make sure to download the report on how to break into industry monopolies. Catch you in the next one.